Good afternoon and welcome to this episode of Keeping It Simple, hosted by our own Mike Green and Harley Bassman. I'm Jenny Rao, part of Simplify's sales team, and I have the pleasure of kicking off today's episode. We're grateful to be joined by Chartered Market Technician Andrew Thrasher, who is a portfolio manager at Financial Enhancement Group and founder of Thrasher Analytics, providing proprietary models and tactical market commentary. In preparation for this episode, Andrew shared with us that he follows Harley's writing, which incorporates a lot of charts. As a chartered market technician, Andrew naturally spends a lot of time looking at charts and is particularly impressed with Harley's use of alluring color palettes and the sophisticated naming conventions for the colors he uses. Today, I'm looking forward to watching Andrew, in turn, impress Harley with his technical market prowess and successes in managing client portfolios through some very challenging environments. Now for some housekeeping items. If you'd like to ask a question, please use the Q&A function on your screen. Finally, today's episode is meant to be fun and entertaining and is not investment advice. Please take a look at the poll on your screen and respond. Is technical analysis part of your allocation process? Yes, no, or a little? With that, I'll hand it over to Mike Green.
Welcome, everybody. Thank you for joining us yet again. And Andrew, it's a pleasure to have you here. Harley, I'm glad you're still showing up.
Yes.
So this is going to be kind of an interesting one. So first of all, as I look at the responses, we get the majority of the responses are telling us yes, that they use technical analysis. And this is probably not a terrible place to actually pause for a second. And Andrew, you're a CMT. I just play one on TV, right? To the extent that you think about technical analysis, what drew you to technical analysis, and what does it actually mean to you when you say that I am a chartered market technician, that I use technical analysis in my process?
Yeah, so I went to school, got a degree in financial planning, and we had classes. I took a semester on trading, and everything you always learn is more that Graham style fundamental analysis. Look for deep value, moats. You learn who Warren Buffett is. And so I never really was exposed to any charting or technical analysis until I really started getting in the industry. And I was kind of very inundated earlier in my career with looking at cash flow and looking at the balance sheets of companies. And you're not buying stocks, you're buying companies, which I found out is not true, at least in my opinion. You're buying stocks, you're not buying companies unless you're Warren Buffett. And so I started trying to do that type of analysis, and it just wasn't making sense. And so then I started reading other people, blogs, and being more exposed online to other opinions and resources, and started learning more about technical analysis, learned about the CMT Association, and that they had a certification process. My very first boss was very big with education. He had 23 designations. So he was all about me getting another designation. So I thought, well, this one would be a good one to get. I can at least learn about technical analysis and what it is. And so that kind of started my path down to become a CMT, get involved with the association, and start using technical analysis. And kind of now 13 years later, we're here, and I'm going to try to impress Harley, which means I'm probably going to need to do some magic tricks or something like that.
Well, and now we all know that the real secret to successful technical analysis is chart color selection.
That's a big part of it.
Is there a default setting that you're using in your charts for the colors? Is chartreuse, or is Harley perhaps a Merlot color?
Today it's hemoglobin.
Hemoglobin. Blood is going to flow in the streets. There we go.
It's funny, there's been writing, and I don't know if there's actual studies that have been done on it, but I've seen some writing where the colors that you have on your screen do have an impact, and that you should try to maybe take off some of those red, green, or things that maybe are going to have a bigger impact to you. I don't really subscribe to that. Pretty much everything I do is a red, green, or black. Most of my charts are line charts, and they're black. I don't use a lot of color.
So to the extent that I'm using technical analysis, I also don't spend that much time selecting colors, but I agree with you actually that it is interesting, because that brings up an important point. And I think it's one of the things that Harley would most want to push on, which is this general idea of how much is interpretation, how much is science, how much is driven by the mood that you're in, is it sunny outside, et cetera. Like when you think about controlling for those variables as you're effectively interpreting a picture that's in front of you.
Right.
How quantitatively have you taken it, or how do you address those concerns?
So you're right, it is. It's very much a combination of science, art. I mean, there was, I think, back in the day, they used to have a study. If it rained in New York City, then typically the market was down that day. Just how it played on their moods. I try to do recognizing that emotion is such a big factor in investing. I try to do as much as I can to be systematic or quantitative, to try to eliminate as much of that emotional interference as I can. It's not something that I think you can completely eliminate. I mean, you could if you just did a black box trading and you had it where you didn't touch it at all, but that's not the approach we take within our firm. But we do try to have some of our larger, longer term models are essentially kind of a black box approach to where they do issue signals and we do follow them. That's how we manage our sector overweights. That's how we manage our what we call risk barometer, determine if we want to be overweight equities or underweight equities. So we do have components that are completely systematic coding that I've built out, or at least chunks of it for the risk barometer. But our sector overlay is entirely technical analysis based, and it's all systematically driven. But then we do have some other reports that are a little bit more discretionary when we get some into the nuanced parts of the portfolio, individual stocks and things like that. But I think emotions do play a part of it. And I think technical analysis is probably one of the best ways to help filter out some of that emotion.
Well, I certainly find this as well. And I often try to remind people of a quote from Adam Smith, which is that price is the mechanism of information exchange in a market economy. And for me, technical analysis, while there's other indicators that play in there, I'm really looking for effectively, how is the price behaving? How is it behaving on a relative basis? How is it behaving in an absolute basis? I'm watching for patterns in terms of volume, where a ton of activity may have happened at a particular price level, et cetera. Are there indicators that you use in particular? People will mention things like moving average convergence divergence or RSI. Are there particular tools that you look to in your tool set that might be familiar to those who are less formalized in their technical analysis?
Yeah, I think one thing that's an easy rabbit hole to fall into when people start trying to get into technical analysis, especially as some of the software and websites make it so easy to add indicators to where you have 7 different momentum gauges on a chart that are all telling you the same thing. And you think if they line up, then you've created this holy grail. So I think trying to keep it as simplified as possible. Some of the most respected technicians that I follow do very much have very, very basic looking charts. They make it look very easy. And it's kind of similar to maybe it does a professional athlete or a race car driver, to where they're so seamless with it. So I think the more simplified you can get with it, the better. So to answer your question, some of the tools that I do use that are more commonplace, relative strength index is something I'm often looking at. I have other gauges that I've built out. There are volatility adjusted momentum, but RSI is a very popular one. MACD, like you said, the moving average crossover divergence. I also look at moving averages. I think those can be very, very telling, not necessarily just from a support resistance, but it can help identify trends. I think markets act different ways when we're, say, under the 200-day moving average for major indices or above it. So we'll use those as well as for support resistance. But I think moving averages, momentum are very useful. I don't get too far into the rabbit hole of Fibonacci or L8 wave. I do some candlestick work, but I don't do a lot of candlestick identification. There are a lot of tools that a lot of people have success with, and it's all kind of about finding what fits your style, your personality, and most importantly, probably your time frame.
And Andrew, I'll tell you, I'm used to Chicago, and at least when I was there, chartists were treated the same as Salem treated witches. Kind of impaled them, and I came to Wall Street thinking this. I'm a kind of a value kind of guy. And as time went by and I was trading the market, I would say I did come to respect and use charting as a tool. And where I used it and how I processed the idea was that I used a chart to discern where the average cost was of where the market people enter, whether they're long or whether they're short, because it's human nature to want to go and break even. So if you buy 100, it goes to 90, you kind of want to wait to get back to 100 before you sell. And so if I know what the average entry price is for the market, I can kind of guess where that will go to and where I'll run into resistance there. Is there more to it than that in your view?
I think that is kind of a very foundational view of technical analysis that it is a voting machine. The market's a voting machine, and the way to quantify those votes through supply and demand is
A voting machine or a greed machine? I think it's a greed machine.
and one and the same. But I think a way to quantify that is through technical analysis, which is the review of supply and demand of the market. So I think it's very much what you said. It's people want to break even, they want to know certain prices, and so I think that's why certain key price levels, we see these patterns repeat themselves, because it is just a place where human emotion does meet, and everyone, regardless of time and technology, a lot of those patterns tend to repeat themselves, whether it's momentum and things like that, on and on.
I'm going to set a trap for you right now.
Oh,
Do you have
good.
an opinion on the market?
Do I have an opinion?
Yeah.
Sure.
Isn't that a negative? Shouldn't you have no opinion at all? I mean, really, wouldn't having an opinion basically bias how you read a chart?
I think it's where the opinion comes from. If your doctor has an opinion that you have cancer, I assume it's coming from a data source, not because his tummy grumbled before he came into your appointment.
I'm not sure I would schedule brain surgery with a chartist, but different idea. I'm serious though. I do think that you're supposed to, if you're a chartist, you should have a blank mind and operate in that manner. I wonder if that makes things difficult if you're bullish or bearish on things. Because like at Simplify, we execute transactions to move the options, the derivatives around within the ETFs. And we try to do it systematically because it always feels the worst at the bottom and the best at the top. And you just can't help yourself. Human beings are like, a bunch of lemmings. We all want to be with the crowd. And I seriously push back on this notion of, I wonder if having an opinion is actually a hindrance for your job.
Yeah, so that's why, like I said at the beginning, that we do have some of our processes, like our sector overlay is entirely systematic. If I really want to own energy, but our system says that we should be overweight healthcare, I don't override that. So I can have an opinion on a sector, but we do have certain principles within our asset management that are systematic. And so I think it's also when you're reviewing the data that your opinion's coming from, I think where it results from. If it's from an analysis of doing your study on the market, and then you develop an opinion that you then express through a trade, I think that's one way to approach the market. The other is a entirely systematic black box approach. And I think we've seen many successful stories come from both ways of managing assets.
Well, so it's interesting what Harley is highlighting in terms of his evolution onto the street, because it's actually very similar to mine as well.
Mm-hmm.
While I wasn't able to gain admittance to the University of Chicago, I went to a less well-known business school and was very drilled into me the fundamental dynamics, actually going so far as to start a software company that was built around fundamental valuation. And I remember first coming onto the street and seeing people do technical analysis and basically treated it as if it was, as Harley has alluded to in the past, reading chicken gut entrails, right? However, I would actually say the exact same thing as Harley. Like, I now look to technical analysis as basically a very simple and quick way of getting a sense for what sentiment might look like or what the degree of momentum is. And you mentioned RSI. That's one of the ones that I use a lot. So I'm often looking for divergences, negative or positive divergences, particularly in the RSI indicator relative to price, effectively to tag components of exhaustion in a direction, right? Much less interested in kind of the day-to-day, but as I look at the bigger moves, I'm often interested in, everyone knows as the price is going straight up that the news flow is going to be very positive fundamentally. That is not going to change until well after the price changes, right? And we see this in headline analysis and everything else, right? So I actually think that we come to this from a very similar place. And you mentioned this idea about using cash flows, et cetera. Unless you're buying, and you also said you're buying stocks, you're not buying companies unless you're Warren Buffett. And I want to actually spend just a second on that, because I think that's actually a really powerful statement, right? A lot of people tend to think of it as you should think of a particular stock or an index as if you're buying the entire company. But you're not at all, right? You are making a forecast on your individual cash flows. You have no actual knowledge of those future cash flows relative to anyone else. This is actually the core of the efficient market hypothesis, right? My opinion should have roughly the same weight as anyone else's. occasionally I'll find situations where my viewpoint diverges so radically from the overall perspective on the fundamentals that it creates some really interesting and useful opportunities. But that tends to be the exception rather than the rule. And it's much more for me in things like FX or rates, where there can be very, there's, effectively the information set is far less knowable than it is. We don't have corporations making reports in the same way as we do national governments. The data sets are just too complex to fully comprehend. But when you think about this dynamic of how to absorb information, when you have this many stocks and this many charts, are you using a algorithmic screening process to identify the sectors, or do you now actually basically just scroll through and look at the same set of charts every single day, or the same set of charts on a continual basis during the week?
Yeah, so it kind of both. So for our sector, like I said, our sector is entirely systematic. We could turn it over to an Uber Eats driver who's going to deliver dinner tonight. He could manage our sector overlay because it's just reading at whatever the rankings are of how we do sectors. For the other analysis that I'm doing throughout the day, yeah, I'm looking at pretty much the same set of charts, and actually the same order, more or less. As I go through, I start every morning looking at breadth, looking at how breadth data changed from the day before, and not everything is actionable. Like you said, looking at RSI, not every wiggle is going to cause a divergence or cause something that you want to take action on. But it's kind of, here's a thesis that we built out. Is that continued to be the case, or has that changed? Has the breadth data improved? Like for recently, where we have breadth continues to get worse and worse every day, we're looking for that data to start improving so we can start maybe increasing our risk allocation. And then looking at what areas of the market are showing leadership. I tweeted a chart earlier today that offensive sectors have been underperforming defensive sectors. So that's telling us that from a sector standpoint, the market is being more defensive, lower risk. The risk appetite's declined based off sector leadership. So we'll look at things like that. Look at international. Look at go through charts just all day long, but they're typically most often the same charts every day because I'm watching the progression there. In the same kind of studies that we run, or whatever custom data sets that we run, we're looking at the progression of how that's changing. Similar to like if you were to have a garden and you're kind of watching things grow and seeing what needs to get the most attention.
One of the things that regular viewers or listeners to my work will know is that I spend a lot of time in the options space.
Mm-hmm.
And within the options market, some of the tools and indicators that we try to use is actually understanding who holds various positions.
Mm-hmm.
So for example, I'll track where are options being traded? Is it against the bid or against the ask, or closer to the bid or closer to the ask? With the obvious conclusion being that something that is transacting closer to the bid effectively represents somebody selling something, right? And something being traded close to the ask represents somebody who is an incented buyer, right? They want to actually buy something. It helps to visualize or to create these dynamics, but it is actually quite interesting that when you do that with that level of detail, you often end up with charts that look an awful lot like a moving average, right? It basically shows the direction of price. And for me, this is actually one of the more interesting things about relatively straightforward, simple technical analysis, is that I really basically can interpret it as who's more incentivized, who wants to buy something or sell something more. Is it transacting against the bid or is it transacting against the ask? In options, that creates some interesting dynamics around dealer hedging behavior, et cetera. How do you think about that within the context of some of the areas or ways that you use this, in particular things like sectors? Are you actually thinking about it in the way you were just saying, which is cyclicals versus defensives, or offensive stocks versus defensive stocks? And how do you characterize those in that manner, right? What does it mean to be offensive? What does it mean to be defensive?
So I consider like a financials, consumer discretionary, industrials, technology, those to be offensive sectors. Typically sectors that do well when the market is in an uptrend or when the economy is doing well. Less concerned about on the economic side, but when the markets are doing better, typically you see technology stocks, consumer discretionary stocks do well. In a risk-off environment, you typically have your utilities, healthcare, consumer staple stocks are the ones that are going to be outperforming. at least in a relative sense. They all might be going down, but in a relative sense, typically those are the ones that are doing better. And so we're looking at which ones the market's showing a preference for. And recently it's been a stronger preference for those defensive sectors. And so that we're not trading directly on that, but it's an input into our filter to determine, is the market increasing its risk appetite or decreasing its risk appetite, and how should we be adjusting our equity exposure based off that?
Andrew, is what you're doing more trading than investing? Like, what is your horizon? Days, weeks, hours?
Yeah, so we have several different models. We have one that is tactical, that is more shorter term, where positions are held for weeks. We have core models where it's held for months or years. We've had some positions that we've had.
Charting held for months or years. I mean,
what's that?
Charting can't work for months or years. That's ridiculous.
Sure. So the way we'll use technical analysis in those manners. So I manage money with a CFA, and so he's much more fundamentally based. And so if he has a company that he thinks is long term, is a good prospect, it's deep value with maybe whatever reason, we'll use technical analysis to find an opportune entry point for that position, recognizing that we're going to maybe hold it through different market cycles. We're not necessarily going to cut it the moment it drops 5%, but we're trying to use technical analysis to get the entry. In essence, if you were going to shoot a gun, he's putting the bullet in and I'm using the scope to find the right place to shoot it.
How do you go and chart Tesla? Netflix is down 75%. I mean, is there a chart for that?
Sure. I've publicly on my blog called The Top in Tesla Twice. You can definitely chart Tesla.
I think, sorry, Netflix, not Tesla. But I guess they both had big moves. I mean, in general, my philosophy, as I noted, is sizing is more important than entry level. And this is very focused on entry level, which is interesting. But if you're a value investor, I guess you could nickel and dime the last penny over here. But is that really the best way to go and invest?
The way we view it is that just because something looks to be of good value doesn't mean the market will start to recognize that value. And so respecting that, at the end of the day, since we're managing money for primarily clients that are investing for retirement or longer term, that we don't want to hold a position that if we think Peloton is at great value in January, it became more valuable in February, even more valuable in March. The market wasn't respecting that value trade, if that's what you thought Peloton was early in the year. So by using technical analysis, it would keep us out of that kind of trade, recognizing the downtrend and recognizing an inopportune entry point, and maybe sit on it. Maybe it's something we don't enter. But technical analysis, by keeping you out of those value trap trades, can be very useful.
What do you do about charting mean reverting instruments? So with the VIX is 19, 20, 21 forever. That's the number. How do you chart that?
So there's a lot of people that I think get in a lot of trouble trying to treat VIX like Apple. I don't believe you can do pattern recognition or looking for trend support resistance on the VIX. You see a lot of those types of charts on social media where people say, oh, VIX should hit X32 because that's resistance. Something that doesn't have supply and demand as far as spot VIX, I don't think can apply traditional technical analysis. Now, I think it does apply using momentum. I think it can be useful in volatility trading, but I don't look at moving averages. I'm not looking at supply and resistance type things on volatility. But I do think momentum is applicable to the VIX.
Let me switch over to it. I guess you wrote a paper a while ago about volatility and level of vol forecasting, a concept. And I kind of think that we're orthogonal on this. So I've basically written over the years, if you look at the MOVE index, which is my baby, you tend to get these huge gaps ups right at the bottom. You have to be below the average before you get the slingshot. And the reason why, and this is for at least for the MOVE, if you get vol, the MOVE or the VIX for that matter, very, very low, that's kind of like Mikey's talking about, where you have sell pressure, people selling convexity, selling optionality, reaching for yield via selling options. And that gets people short convexity, short optionality, short gamma, which means if you get any kind of market move, all of a sudden you have a big problem. And therefore, I think you need to get a very low vol to precede a big move. And you've said it's the opposite of that. It's not predictive.
Yeah, actually, when you look at the spikes in volatility, volatility almost very, very, very rarely spikes from a new low, from a 21-day low or a 3-month low. Volatility typically spikes after it's already started rising. If you look at the kind of the picturesque VIX spike from February of 2018, volatility had bottomed early in January and had been rising till it actually had that Volmageddon event in early February. Very rarely do you see the VIX spike in the sense of a 2, 3, 4-day extreme move from a very, very low place. Most of the time, the VIX.
We're really talking timing then. I'm looking at a longer horizon. You're looking at a shorter horizon. Okay, I can live with that.
Yeah. So what my paper was on was that volatility compresses, and that's what precedes these shorter term spikes, not looking at weeks, months, but looking at days.
Fair enough.
Yeah.
Fair enough.
But I actually think that that's actually a really interesting fundamental question, because one of the things that happens in the option space, right, is that you have positions that are taken, and I would argue this is very similar to watching a similar type of behavior in an individual stock, whereas something like a Peloton, for example, gets pushed lower and lower and lower, the natural seller, the marginal seller that often emerges, is somebody who develops conviction around fundamentals and said, oh, this is a no-brainer short, right? This is the easiest thing in the world to be short. Something similar happens exactly as Harley is describing in the volatility space, where volatility contracts are written. You enter into a short volatility position, effectively a short Vega position. Harley is, as you would highlight, used for yield enhancement, used because your models have told you that it's always smart to sell volatility and you're going to win 90% of the time, and you convince yourself in one form or another that this is just another one of those examples, right? I mean, we see this with the steepness of the vol surface that preceded events like Volmageddon, where effectively everyone had crowded into the XIV because of the very simple observation that the carry was so hugely positive. When all of those people are in that position, when everyone has gotten into that position, whether they are selling out of their Peloton position or shorting the VIX because it is a no-brainer through a product like XIV that makes it appear super, super simple, that this is just an easy way to make money. The unwind of that, the violence of that move, is often something that I think Andrew and I would both be highlighting in this type of dynamics. The same thing I think you're seeing in the move index, where it has to start moving a little bit. Once that move begins, then people begin unwinding their positions. People are less willing to write that short volatility contract. Even though ostensibly it is a more attractive position to write it, having nursed some losses, they have less capital available, they have less confidence in their position, and then it can blow up very, very quickly on you. So I'm not at all surprised by Andrew's research. I actually think that they're very similar in their structure, but it does open up a different question, which is, if we look at what's happening to volatility, both realized and implied now, we seem to have stabilized at a much higher level than we have in previous cycles. And I'm interested in how you would interpret something like that, Andrew.
It's funny, this actually was going to be a question I was going to ask you too. I highly respect the work you guys do in volatility. And I've gotten the question from several people of why we're not seeing higher highs in the VIX, where the market's been going down, and is that a bullish characteristic? And traditionally it is. Traditionally, if you don't see expansion in volatility, that's can be used as a potential maybe indicator that volatility signaling, maybe we've seen a low. Something that I often try to remember is that VIX isn't going to, it can't be treated like an index, like Harley said, that it is capped. You're not going to see a VIX of 1,000. It's just not going to continue to go higher. And so I think when you get to the point where you do get VIX in the 30s, that is signaling what, 2% daily volatility.
Roughly, yeah.
Doing mental math. And the market's accepting of that. It's still a high level of volatility. And so the market doesn't need to start pricing in 3-4% volatility unless you start really having more, that's more event type driven. And so just because it's been a pretty calm decline and we're not really seeing oversold conditions, we're not seeing this capitulatory type trading, that VIX saying that 2% volatility is normal is why we're not, in my opinion, seeing that expansion in the VIX. Now, I'm very curious how you two would interpret that.
Well, Charlie, you want to take that first?
Yeah, the reality is that if you look at short dated options, 1 month, 2 month options, on liquid instruments, so SPOOs or the 10-year rate or whatever it might be. In general, the key, most important driver is realized vol, and that's it. Don't think so hard. That's it. You tend to see implied vol trade 8 to 12% over realized forever. And that's why you have some of these large hedge funds or large asset managers basically sell 1 month options every single day. You delta hedge once a day at 4 o'clock, and they'll earn the 8 to 10%, 8 to 12% premium with the occasional blow up where they lose their money. It's an insurance business. Mm-hmm. And the reason why the VIX is relatively stable right here is we haven't had any big gap moves. We're moving, right. 1.5% a day, and that's kind of it. The move, which, and there's some great charts out there showing move versus VIX, which, by the way, they go in line in this grand macro space, but day to day, please don't trade one versus the other. That's meaningless. But if you look at the relative, 20-year history of both, the move's much higher than it has been. And the reason why is the Fed's active. The Fed's going and the Fed's uncertain. And we have had huge moves. We have multiple, 8, 9, 12 basis point days. So it is realizing, especially the front end. I mean, today, another 10, 12 bips in the front end driven. So I think people looking for answers, they want to hang their hat on something, but the cold reality is it's just driven by 30-day realized or 21-day realized.
So you don't attribute when you start seeing the move increase more than equity. So when bond volatility is rising more than equity volatility, you don't think that's a leading indicator that equity volatility is being underpriced? Like kind of what we saw in November, where VIX went from spot 15 to 35, or here recently, where you had the move index was almost back to COVID highs before equity volatility really started to advance. You don't think those two are connected?
Not one look. I mean, in the big concept, when you have big volatility, all financial assets move and all vols rise. But I mean, one versus the other doesn't tell me a whole lot. All it tells me is that rates are moving a lot more than the stock market is, and that's been the case. I mean, rates have moved proportionally much more than equities have, especially when you start from these very low rates. You move 10 basis points with rates of 5%. That's a kind of small number. You just move 10 bips with rates at 1. Well, now it's getting kind of active over here. I mean, I'm more curious, actually, kind of not switching topics exactly, but specifically about interest rate, forecasting, your tools. I'm a believer that the Fed has printed money. Mike disagrees, but they've printed money. They've created a haystack of money that's been now lit on fire. But going back over the last 10 years, they had their thumb on the scale via rates at zero, via quantitative easing and everything else, and created basically, except for a few blips, a decade of nothing. And I had a friend of mine, he's going to go and take out a loan, an ARM, and it's going to go and be some number over LIBOR, over SOFR. And the bank said, oh, look at this, the 10-year, the average SOFR is 77 basis points. I'm thinking, that is totally bogus. The last 10 years has been controlled by the Fed. There's no information there. You can't make any kind of prediction about that. Doesn't that bother you that we've had the Fed control financial assets for a decade? And basically you have almost no information at all. That's been a key point I've had, is the Fed created moral hazard by basically blocking the channel of price discovery and price information.
So you don't think we've had price discovery for 10 years?
Not one look. Rates are zero. Where's the rate discovery in Japan? They own most of the ETFs in the market, and they've kept the 10-year rate at 25 cents, rain or shine, life or death. They have a deficit now, triple their GDP. There's zero. The only information there is when's the currency going to go to toilet paper.
So you're assuming that all traders are just trading with a blindfold on because the Fed is doing journal entries by putting money into banks that are sending it back to the Fed.
I think you had the euro, the green euros trading at 99.5 or 99.75 for a number of years, relying upon the Fed not doing anything, and now it's trading all of a sudden 96.5, and no one saw it coming because they relied upon the Fed, and they're just. I mean, the Fed is they're not the primary villain here, but they are a prime villain of financial distress by creating moral hazard, by manipulating the market. Same thing with inflation. I mean, they own over a quarter of all the tips. For the last year and a half, they've bought more tips that have been net issued, and then people are going to go make a prediction about inflation based upon tips prices. That's nuts. The whole thing's manipulated.
So if they're manipulating, use that word loosely, if they're manipulating fixed income markets, how do you think that is causing a rigged equity market?
Well, I mean, equities are just discounted cash flows. So, I mean, they're
But
equities
the
are not
pushback
as
on
rigged.
that, Harley, is that the discounted cash flows are unknown, right? So you have to make an assumption about what those cash flows are to discount them.
They usually have two variables though, right? You have the earnings and the discount rate. Now you take the discount rate and collapsed it and pinned it. That's why you have the FANG stocks exploding higher, because all they are is a giant, forward trade on earnings that we're pretty sure that Amazon's going to make $1 trillion, in 30 years. I'm not sure what the PV is to bring that number back. But so you've now gone from having one unknown to having two unknowns, right? Because now rate is unknown.
Yeah, it's so I guess one of my quick pushbacks would be that if that were the cause of why rates have now sold off, wouldn't that be impossible in your model because the Fed has actually not stopped purchasing? I mean, the move in rates happened long before the Fed changed its actual policy.
How do you chart LIBOR when the Fed pins the rate at zero?
I'm not suggesting you should chart LIBOR. That actually wasn't the question. The
That's all
question
the
is
same
what's
thing,
happened
isn't
at the
it?
long end in terms of bond prices. If it was actually the Fed's purchases that were manipulating it, we have seen actually a reduction in issuance, and we've seen the Fed maintain its pace of purchasing, which, if anything, should suggest that the long end should have had even lower rates.
How much lower do you want to get? You put the 10-year in.
No, I'm not selecting a level. My point is that the Fed has actually, until basically next week, I believe it is, has continued to purchase bonds, right? So they have not changed their pace of purchases. And yet we've seen bonds sell off to the greatest degree in history, basically, on a relatively short period of time where the Fed has not changed its policy in terms of the actual execution. So it indicates that it has to be somebody else who was steering that move. Right now, I'm not suggesting it's a single individual, but it does suggest that the market itself is capable of influencing rates quite significantly.
Rates are still way too low relative to inflation and nominal GDP. And
Right,
by
but
the way,
move,
the drawdown,
move,
the rate drawdown, bond drawdown is a little skeezy here because if you compare other periods, you're starting at a much higher rate level before rates went up. So therefore, the duration of bonds was much lower. I mean, you're looking at, I mean, in the 94, you're talking a DV01 like 14 on a long bond. Now you're talking 24. So on a price move, it's a vastly bigger difference. So to say this is the world's biggest drawdown is a little deceptive relative to what's going on. It's a little bond math being, passed on by people not noticing.
If you think that's deceptive, if you've seen the stat, I think it's from Bank of America where they're doing the drawdown adjusted for inflation, that we've now exceeded the 2008 financial crisis equity drawdown, because when you adjust the drawdown for inflation, it's been like, we're now down 28%. It's percent, no, be six, yeah.
People that need to publish every day have to go find a good toy to show. They need a shiny object and to distract people.
So when we think about that type of dynamic, though, and this, kind of brings me back to the question around the VIX, right? The question has been asked: do we think we're going to have another VIX spike in the future that did COVID lift VIX to a much higher regime? So I think that there's a couple of answers around that, and they actually kind of boil back down to points that Harley is raising, which is prior to COVID, we had a number of market participants, some Canadian pension plans, a well-known ex-Goldman Sachs group of individuals running a volatility fund that were very active in the selling of the extreme right side tail, right? What's referred to as uncapped variance. And this is basically offering insurance to the market for extreme spikes. Those firms blew up in March 2020. March 2000 is a slip there, obviously. But in March 2020, those blew up. And we have not had the providers of that type of insurance to the market. And so one of the things that I think is absolutely playing through in the VIX is there is a much greater fear that effectively nobody is able to buy insurance against the really out of the money move, right? And the VIX itself reflects the pricing of all of the strikes of the S&P 500 options at the 30-day expiry. that to me is playing a primary role. Effectively, we're looking at, down 50% in many situations. You're seeing implied volatilities that are just at extraordinary levels that are in line with the type of spike that we're referring to. The question of why have we not seen a bigger spike? I mean, I would broadly argue that we now have been spoiled by kind of the two big crises in volatility that have occurred in the past 5 years. Volmageddon, the dynamics of the XIV blowing up, that was very clearly a position where the short volatility trade itself had gotten extraordinarily crowded, and we were watching largely an unwind of that event, right? So those positions blew up. The March 2020 components, we were literally moving 10% a day in many situations, right? And so if I reverse engineer what we're talking about there, hitting 80 on the VIX, again, to use the volatility math, is somewhere around an expectation that you're going to move 6 to 7% a day, right?
For 30
we
days.
were actually realizing that, right? So, will we see that again? I think it's very hard to know whether we're going to see that. But, one of my theories is that we have entered into a structurally more negatively skewed and volatile environment as more and more price insensitive buyers represent a sizable fraction of the market.
That's because of passive, not because of option sellers.
It can actually be both, right? So the dynamics of option sellers, we have two separate components that are playing in there. One is the Dodd-Frank rules means that they can warehouse far less in terms of inventory, right? So they just can't take the same types of risks. This is certainly true for the Goldman Sachs's and the major, what used to be brokerage firms became banks in the global financial crisis, right? So their regulatory framework under Dodd-Frank reduces their ability to take that sort of directional risk. The second thing that I would argue is broadly going on is because of the passive dynamic, right? So it is, in the words of Valentin Haddad, a UCLA professor, it has raised the inelasticity or lowered the elasticity of the market, its ability to provide supply and demand on a change in price to levels that we've not historically seen. And so under those conditions, you would expect the market to exhibit greater fragility or greater ability to move in an unexpected manner on small changes in supply and demand. And it seems to fit fairly well with the data sets that we have. And then the last point that I would make is we were lulled into complacency around the 2017, 2018 time period. And this goes directly to Harley's point about what happens with the move, where effectively the implied correlations of the markets had just completely collapsed. And so index volatility, which is what the VIX is, has two components to it. It has the level of the realized and implied volatility of the individual components of the S&P 500. But then it also has an assumption about how much they move together. And as we went into 2017, the expectations were that basically nothing moved very much in together, right? And that was matched by some of the realized stuff. Now, those who've seen my presentations on this understand that my argument is that is a function of this volatility selling itself. We effectively had stockpiled major quantities of short vol that created a market that mechanically was rebalancing itself in a way that it just didn't move much in any direction until it did, right? And then volatility spiked. The real move in Volmageddon was actually on the implied correlation. It wasn't so much on the level of volatility in the market itself.
I have a comment and a question for Andrew. The
Sure.
comment is, I think it really matters who is selling the vol. If you have Susquehanna and Citadel selling it, that's a whole different animal than some retail or some small hedge fund trying to scrape on by and make a few pennies, who has stop loss limits. And I think Susquehanna and Citadel, they kind of know what they're doing, and they can manage it much better than other people. They are actively. But the big problem in options is that the Black-Scholes model assumes continuous hedging, as much volume as you want at every price, which is not a reality. But if you're ever going to have someone who could actually trade continuously, it's going to be Susquehanna, Citadel, and those big market makers. So putting that aside, though, Andrew, one of the things I've been really kind of focusing on, and Mike and I kind of bat around a lot, is I think the number one risk for the financial world is the correlation of stocks to bonds. And for the last 20 years, they've been negative. I'll use the word negative, although it really isn't, but where stocks up, bonds down, vice versa. 60-40 portfolio has a lower risk profile because as one goes up, one goes down, and there you have it. And if we get rates above, inflation above 2.5, 3, rates above 3.5, 4, historically you've seen that correlation go back where stocks and bonds go up and down together, which of course would be a total disaster. And you saw this happen twice recently, once in March 2020, and then November, December of 18, which is when the Fed jumped in to save the world because everyone blows up. Do you do any work on that kind of concept of a second order charting of correlations as opposed to single order charting of single assets? And maybe it's not relevant at all.
I'm trying to understand what you're asking. When you say second order, do we chart equities to bonds? I'm not sure. I'm not following what your question is.
Is there anything in your skill set that could zero in on the correlation between various assets? Mike, you want to go and expand upon that or ask it in a better way?
Well, so this is one of the areas that I think is actually really important, and I hope people are following this, because there is actually a really important difference between the volatility or behavior of any one individual asset and how that aggregates up to the portfolio. And so, there's a question in our Q&A asking about, can Apple, a large stock within the index, spur a Volmageddon type dynamic? My immediate reaction to that is no, for the very simple reason that as large as Apple may be within the S&P 500 at 7%, it really can't actually drive the volatility of the index itself to some extraordinary degree, right? For two reasons. One goes back to this correlation. So if something happens in particular to Apple, that's idiosyncratic to Apple. It's actually going to lower the correlation that's embedded in the index. But the second point that Harley is making is that when you have a portfolio that has two assets in it, and let's just call them, umbrellas and sunscreen oil companies, to use the classic example, if they move in opposite directions, right? So umbrella companies go up when the rain comes, and sunscreen companies go up when the sun shines, and therefore the two cancel each other out. That allows you to have a portfolio. The portfolio itself exhibits much less volatility than the individual components themselves, and I can run a larger exposure, right? The traditional dynamics of a bond equity portfolio that goes back into the 1960s and 1970s was very simply that bonds offered a continuous yield and were much lower volatility assets than equities. They didn't necessarily offer that dampening effect, but they did lower the volatility by having a lower volatility asset in the portfolio. Around 1998, as the central bank, the Fed, and other central banks around the world began targeting asset protection, effectively trying to forestall financial asset collapse by cutting interest rates, it introduced this dynamic where bonds actually moved in the opposite direction to equities on a fairly continuous basis, creating a sunscreen umbrella portfolio effectively, right? That has allowed the introduction of much more levered portfolios that have much larger aggregate exposure. And I think what Harley is ultimately saying is, if that goes away, if the Federal Reserve is forced to start targeting inflation as compared to asset prices, do we end up in a situation where even if valuations get lower or stocks become, theoretically less risky, does the overall portfolio become much more risky, and therefore you need to reduce the aggregate purchasing of financial assets, which theoretically should be very negative?
Yeah, at first blush, I would say yes. Looking at working for an REA, managing retail client type of investment portfolios, that we very much have to take in the volatility of an entire portfolio into consideration. And so if you're not getting volatility dampening from your fixed income portion, your traditional 60-40, if that 40 is not dampening the volatility of the 60, then you do have to decrease risk across the board, whether that's through adjusting duration or credit from the fixed income side, or adjusting kind of the beta exposure that we have on the equity side. But we do take into account the total risk within the whole portfolio. And if the traditional diversification isn't working, then yeah, action typically does have to happen, because that is one of our key things we're looking at, is total portfolio volatility.
And this is one of the things, Harley. I mean, we had Stephen Van Meter on in the past episode, we've had others who we talk to on a regular basis. Corey Hofstein is a big proponent of this, where the portfolio construction is effectively designed to limit the overall volatility, right? By timing it moving within equities and bonds. It's very similar to what you're proposing ultimately, isn't it, Andrew? That you're looking maybe to a broader range of instruments, but ultimately, again, targeting the portfolio as compared to, hey, I'm really going to try to make my S&P allocation work well.
Right. We're looking at the total sound from the orchestra, and we want all, if certain instruments are out of tune, then we need to adjust those, but we are looking at the whole picture. And so right now, I think that's very difficult for a lot of individual investors and a lot of fund, kind of RIA funds like ours, where you don't have several investors that I talk with who do very passive 60-40 using funds, and they're very confused and they don't know how to adjust these types of movements, because all the charts they're getting, because we're getting the same one from wholesalers, are all data sets from 1980 and saying, well, here's how markets traditionally work and why you want to have a 60-40. And if you just hold on that 77% of the time the market will be up by the next year, and they all are looking at stats during the 30+ year bull market, and that may not be the game we're still in, as you're suggesting, which I think is really important and something that I think is catching a lot of people off guard.
I don't want to put you on the spot, but before the clock runs out, I know people want to have some meat to chew on, especially after today when they got their bellies punched. Are you willing to go and give us a quick and dirty comment on the chart outlook for the next, call it, month or whatever the horizon is for you? Think of oil, gas, where Russia might drop a nuclear bomb in the middle of Ukraine, gold, which has done nothing, tens, and SPOOs. Did you have comments on those, thoughts on those, from 30,000 feet?
Yeah, so we've been, one of the sectors that we are overweight in has been energy. Just as,
is that a fundamental thought or a technical thought?
Technical. It's entirely, again, that's going to what our entire black box, and it's all based off technicals. So the technicals are saying energy for our rotation. S&P, we're continuing to look at more decreasing risk than trying to look for opportunities to add risk to the portfolios. We still believe that we're in a bear market that's not showing signs of lessening as of yet. Gold was really interesting. The fact that you had these big spikes in inflation and what was considered to be a traditional inflation hedging product, and it didn't do anything, as you said, it's gone nowhere. I think you could probably put some black hat reasons why when you look at Basel III and some of the way it's being treated as for banking assets. That's a whole nother thing. I think that's why gold hasn't moved. But traditionally, we are constructive on commodities as a whole. We're currently not taking any specific commodity risk. We're looking at more baskets of futures to play commodities with a slant towards ag and energy is what we really like. But just from managing risk, we do it from a basket approach. So we are more bullish on commodities. We think that theme continues to play out both from the narrative fundamentals as well as the charts and the technicals. I think both tell that story. Equities, we continue to think that the market continue to head lower. Interest rates are really, really tough. We got to 3 and then we start 10-year pull back from 3. Whether that's because we think that maybe traditional hedging is trying to come into play, where you are seeing investors try to shift out of equities into bonds as a way to seek a safe haven asset, or if it's just the fact that interest rates have already played out their song and the market's already priced in all the rate hikes the Fed's going to do. I think fixed income is going to be a really difficult year. And we've probably increased the activity in our fixed income portions of our portfolio, really trying to navigate that storm a little better. Whereas other years we might not have to play as much in our fixed income portfolios. But yeah, probably the most bullish on commodities, not real bullish on equities. Gold, fairly agnostic at this point, as break-evens are starting to tip back to being positive. And 10-year below 3 is interesting. I'm curious if we get back above 3 and where it goes from there.
Not to put you on the spot, but what is the bottom going to be in SPOOs? I mean, there's people looking at like a forward PE. They might think 3,500, 3,600. If you're going to trim the earnings by a bit, put a 15 PE, you get 3,000. Or you could be, Hussman or Grantham and think we're going to 0. Because
I'm fairly late. I'm fairly lazy, and so if I'm looking at a PE, I really don't care about the E portion of it. I only care about the P portion of a PE. So I'm not looking at all what valuations, what PE ratios we get
Exactly.
to.
So you think the bottom, I mean, where's the safe bottom for someone?
Yeah, so I don't think there is a safe bottom. I talked with someone from Bloomberg yesterday. They asked the same question, so I'm surprised you're asking it too. I don't think there is a
Well,
price.
this is an ask artist.
There's not a
The only
price
question
level.
to ask you.
There's not a price level that I'm looking for. The next level of interest would be 38.47. That's the volume weighted average price since the March 2020 low. We've cut through support levels. We got below the October 2021 lows. Those didn't hold a support. Then we got below the March levels when we had the first counter trend bounce. I think drew in a lot of people expecting that to be the final low. And then we broke right below that. So the fact that we're breaking support levels or key levels is telling us that the sellers are remain in control. People today, it was all about, we're at the 20% drawdown mark. And that's causing people, when you look historically, when we get to that 20%, it's never been significant for the market. I mean, you don't see the market automatically turn on a dime just because we're down 20% in a drawdown. So the next level of interest for me is 38.47 because that's the VWAP from March 2020 low. If we go below that, then the sellers continue to be controlled. So I'm just continuing to watch as we step down, and do buyers ever come in at any of these key levels? If they do, then we're interested to see if they can get it to turn around. But so far that hasn't been the case.
Now I ask because, I mean, when you get very high vols and very big skews, you get really interesting trades if you have a little bit of a stomach. So a number of months ago, I bought the 425, 400 put spread and then sold the 330 put. So I got this ladder of sorts for zero cost. And now it expires in June. So it's kind of right in the kill zone right now. I'm thinking if I do another version of this thing, I want to know where that bottom strike is to sell where I'm safe. I mean, I thought 330 in June was a safe trade, and I'll find out in a month.
Yeah.
If I'm going to do the trade in September, where's that bottom strike going to be?
Yes, I mean, if you're for June, yeah, I don't.
September.
Yeah, I mean, kind of after that, then you're starting to look at those 2020 highs, which is getting you back to 3,400.
Okay.
But again, I don't know that we're going to get there.
I'm
just continuing to every day just watch how the supply dynamics change, supply demand dynamics change each day.
So I think this is one of the things that I think is actually really important is, and I certainly think about it this way, that I always treat it as effectively stochastic, right? What happens tomorrow could very well change the picture quite significantly. It doesn't necessarily change it, right? But if we were to walk in tomorrow and Putin were to announce a surrender and Xi were to suddenly embrace capitalism, and, you know, like we would all turn around and be like, oh, I had to fully expect the market to be up, right? But, you know, what's the right price? What is the right price under that scenario? I don't think anyone really has an actual idea, nor would we argue that the simple fact that they came out and made those statements demonstrated that they were actually going to do it, right? So we've got lots of, anecdotes along the lines of CEOs speaking, right? How do you tell if a CEO is lying? Their lips are moving, sort of stuff, right? I would suggest politicians are no different in that framework, or regulators. When you think about Harley's trade, one of the things that I love to think about is this kind of dynamic of what happens as volatility gets priced higher and higher and higher. And we're kind of in that range now, where unless the world becomes largely uninvestable, and I would broadly describe days where, you know, on a continuous basis, the S&P is going up 4%, down 4%, or down 4% on a somewhat continuous basis, punctuated with a 10% rally followed by, you know, another 20% sort of decline, similar to what we're looking at now, that effectively people start throwing up their hands and saying, just take me out until things calm down, right? You see the same thing with option dealers. You saw this with the meme stocks, for example, which if you looked at what market makers did, they basically just put volatilities of 1,000% on some of these names when they were trading at the all-time highs. A volatility of 1,000% is almost impossible to make money on buying an option. And that, I mean, there's an incredibly insane scenario in which it happens. But to Andrew's point, like, you don't see the VIX go to 1,000 for the very simple reason that it just can't be sustained, right? Nobody would bother to buy that option. Nobody would bother to speculate in that, unless, of course, they're using an app like Robinhood that doesn't tell them implied volatility in their prices at all. And I think that was one of the really interesting things that transpired is that professional traders who have full exposure to things like an implied volatility level looked at the pricing of the options in AMC, et cetera, and said, this is bananas. Everyone I know was selling those options and printing money in one form or another at the same time that the Robinhood app users were saying, oh, good, it's a 5-cent option. I could make 100 times my money on this, but they were actually buying it so far out of the money to get that 5 cents that, you basically would have had AMC replace Apple as the world's most valuable company in order to have that
And
happen.
some still think it will.
Well, we're moving to a world of Planet of the Apes, so perhaps that does indeed happen. This was a fantastic discussion. I genuinely appreciate, Andrew, you putting up with Harley's cantankerousness. And Harley, I appreciate you being open-minded to the discussion. Hopefully the audience enjoyed this. We're going to pass it back over to the much more attractive and well-spoken Jenny Rao. Jenny, thank you for hosting us. And I look forward to everyone joining us in our next KISS, which, if I remember correctly, we're actually going to get Lynn Alden on. Is that right, Harley? You don't know.
Right.
All right.
Well, we'll have to leave it here. So I'd like to wrap up by thanking Andrew for joining Harley and Mike this afternoon, and to our wonderful audience for your interest. As always, a replay of this episode will be available on our website and on YouTube shortly. If you have a moment, please fill out the survey that pops up on your screen after we conclude. And as Mike said, please join us next month for the Keeping It Simple with special guest, Lynn Alden. Have a great evening, everybody.